Hi there, Dan Kurz, DK Analytics. It is July 1st, 2020. Thanks for tuning in. I'm coming to you from Niederwening in Switzerland. I actually wanted to get this video out yesterday, but couldn't finish things up, so here I am today. Hopefully it'll be worth your while to listen. I thought long and hard about the title of this video, and I came up with nothing better than going vertical on the J-curve of destruction. Let me get to some valuation metrics briefly. The U.S. dollar index, DXY, stood at 97.37. All these valuations are the most recent prices I could get either today, intraday, or as of yesterday's close. The Fed's balance sheet stood at $7.1 trillion, down just a touch before I think we're going to see another big increase in it. I'll get into that. The U.S. 10-year, the yield I last saw was 0.69%, kind of treading water. The S&P 500, 3,100, still in a recovery phase or a bear market bounce, I'm going to say. Oil closed or stood recently at $37.79 per blue barrel. Meanwhile, gold I recently saw at $1,787 per troy ounce, edging closer to $1,800, and silver, meanwhile, stood at $18.57. Let me get into a topic. There are increasing recent signs that, to me, point to a U.S. economy that is succumbing to ever more misallocations, sustained yield starvation, rampant redistribution and cronyism, virus shutdowns, property rights eviscerating, Main Street maker pummeling, deficitary policies. And this despite, or perhaps more accurately, because of record money printing and surging debt. Let me briefly highlight the goings-on. May's U.S. merchandise trade deficit widened to $74.4 billion, up 5.1% month over month, which constituted an annualized deficit of a whopping $893 billion. Plus, April's merchandise deficit, trade deficit, was revised up from $68 billion to $70.7 billion. Meanwhile, U.S.'s goods exports in May fell by a whopping $5.5 billion compared to April, underscoring collapsing global trade. Speaking of world trade or global trade, it started to take a hit in late 2018, as you probably recall, as tariffs, counter-tariffs, and threats of tariffs negatively impacted supply chains. Year-over-year declines in world trade volume, became a regular feature starting in June of last year, in essence a year ago. Then, in March of this year, the index dropped 5% year over year. And in April, it dropped 16% year over year. This has brought the index down, and I'll show you a graph of it in a second, 18% from the peak in October 18 and back to where it first had been in January 2008. Here is the graphic representation of that, courtesy to Wolf Street site and a chart that they feature on it. Here's what I'm talking about. Okay. So we see this growth, and then topping out, 18, more trade war friction, and then coronavirus, boom, falls off the cliff. Back to January 08 levels, right? Back to here. As world trade constitutes a marked part of both global economic growth when it's positive, or global and regional or national economic shrinkage when it's negative, this is not to be underestimated. We have a globally intertwined economy, in short. Actually, U.S. trade took an even bigger hit than global trade, with exports of goods collapsing 30% year over year in April, according to the Commerce Department in early June. Imports, meanwhile, plunged by only 20%. Good law of bigger numbers is going to have something to say there, but net, this is going to take a significant chunk, a further chunk, out of U.S. GDP growth in the second quarter, which is already going to be cut about in half, but I'll get into that. And I don't say that lightly, but all right. Let me shift gears. Let me also address, beyond the trade, something I call corporate anorexia in America and increasingly throughout the West, and the associated de facto LBOing of corporate America that has been going on for quite a few years, fueled by the Fed's ZIRP policies. Right? It was put on hold after the spring market swoon. The C-suite stopped buying back their company stock at elevated levels. Look for dilutive secondary stock sales at depressed prices as the current stock market rebound, inevitably succumbs to economic and financial reality, be it in terms of hugely compressed earnings per share, or in terms of corporate liquidity and or solvency issues, both of which are rising concerns with the huge number of so-called zombie companies constituting the corporate sector in the United States. For a preview of coming attractions here, in other words, a lot of dilutive offerings, look at the depressed financial sector, the banks, in particular at Wells Fargo, which recently filed for a $66 billion mixed shelf offering. My bigger point here is that over-leveraged corporations will have to focus even more than usual on balance sheet stabilization rather than on organic growth, further denting corporate and economic growth potential. We shift to the U.S. federal government. 55% of every dollar of federal spending over the past few months has been financed by the Fed's printing press. Year over year, the Fed's printing press has expanded by 84%, almost $3.5 trillion to $7.1 trillion, and the Fed's talk of underpinning the corporate debt or bond market, keeping interest rates low despite rising corporate liquidity and solvency issues, this has now morphed its Fed's talk of buying corporate bonds into its first tiny purchase of corporate bonds, including a symbolic $15 million purchase of junk bonds. That toe in the water by the Fed, that toe in the water purchase, is a cheap way to convince speculators to purchase junk bonds at elevated prices because they know the Fed has their back. In short, the Fed is beholden to Wall Street speculators as well as the member banks that own it, as we keep getting reminded of, including last fall during the Fed's repo bailout. The Fed is also beholden to the politicians. You know that story. And we all know that such an indebted, malinvested economy would collapse under its over-indebtedness if price discovery / free markets again determine bond and stock prices. In a related manner, never mind that the Fed's charter is supposed to allow for corporate bond purchases. Yet, the U.S. Constitution stipulates that states were only supposed to have gold and silver-based legal tender or money. This was so that money couldn't be printed for political or redistributionist/crony reasons. Alas, one more nail in the rule of law coffin as we increasingly ape banana republics, America and the West at large. The fallout won't be pretty, as history has attested to many times. No country is immune. And economics always ultimately trump politics, no matter what the country's name or how high it rose prior to succumbing to counterfeit currency creation. Separately, $2 trillion in additional federal debt was added in April and May 2020 alone by the U.S. government, which, if annualized, would yield a $12 trillion federal deficit, or nearly half of the current operations-based federal debt of over $26 trillion. By the way, it took 199 years from the date the Constitution, the U.S. Constitution, was adopted for the U.S. government to accumulate $2 trillion in debt, namely by 1986. And it's no accident that for the most of those 199 years, the U.S. was on a precious metals monetary standard. Returning to U.S. macroeconomic news, the BLS, the Bureau of Labor Statistics, reported 345,000 net new U.S. business formations in May of 2020, based on its birth-death model, of which the biggest contributor was, get this, the leisure and hospitality industry, where 48% of the growth in net new business formations was aggregated. This is the industry, right? Leisure and hospitality that got clocked by the coronavirus, and most especially by the virus policy response, creating the biggest volume and sales collapses of any industry short of possibly retail. More U.S. statistics credibility issues? I think so. In a related manner, and at least tangentially confirming how bogus the BLS New Business Formation Report is, the number of people who continued to receive unemployment compensation in the week ended June 20th, that is, under all state and federal unemployment insurance programs combined, including so-called gig worker compensation, that tally of people receiving unemployment compensation rose to 30.6 million previously employed people in the U.S. That tally, that 30.6 million, is 1.3 million more people than the prior week, and the second highest tally ever, according to the Labor Department, the U.S. Labor Department. I'd say that such numbers are not exactly conducive to a V-shaped economic recovery, especially as 30.6 million terminated people without work is the equivalent of 19%, of February 2020 civilian labor force level, the U.S.'s civilian labor force level. And also, given the fact that nearly half of all U.S. small businesses employing nearly half of the U.S. private sector workforce expect to close their doors permanently in the near future. During May, 25% of U.S. household income came from government checks financed by mainly more money printing. This is why consumer income surged 10% and consumer spending picked up. Yet we know that more income and less production, less services, always constitute a recipe for inflation, not sustained growth. You can't print growth. You can only print inflation. Speaking of too many dollars chasing too few goods and services, or in this case, an economy that is set to collapse by around 50% year over year in the second quarter that ended yesterday, June 30th, consider that US M1 at $5.2 trillion has expanded by 35% in 1 year, while US M2 at $18.3 trillion recently has expanded by 24% over the last 12 months. Compare that to an economy collapsing in 1 quarter by 50%. Let me now turn to politics. Now, let me start with something that might be out there but might be closer than we think given the election ahead if it turns out against the Constitution. House Democrats have passed a bill to make Washington, D.C. the 51st state. That state would have 2 senators and I believe 5 representatives, given its population. Given the makeup of that population, D.C.'s population, that would likely mean 2 Democratic senators and 5 Democratic representatives. This would make it extremely difficult, if not virtually impossible, for the Republicans to win the Senate. Should Trump lose the presidency, heaven forbid, and the Dems retake the Senate, this is likely to turn into a one-party rule reality, in my view, perhaps reminiscent of Sacramento. Separately, with multi-trillion-dollar U.S. stimulus packages having largely run their course, the checks cut and paid and cashed, yet the economy is still reeling under shutdowns, even more bankrupting regulatory compliance mandates, and with nationwide looting, vandalism, and riot-induced murder raging, look for additional multi-trillion-dollar money printing financed stimulus packages sometime later this summer. That's why in my opening metrics remarks I said just wait on the Fed's balance sheet. It's going to zoom higher from that 7.1 trillion. Well, such stimulus packages will throw monetary and fiscal caution even further to the wind, given that it is an election year. Remember, November 3rd, the U.S. election date, is only 4 months away. The politicians will be falling all over themselves to spend out of an empty pocket. If it is Trump's $1.2 trillion infrastructure program that the Democrats may be able to support, really record pork spending, or whether it's Congress's second stimulus package, where the democratically controlled House has targeted a $3 trillion stimulus package to endear themselves to voters. Let me move on to a tired but still very timely topic, the coronavirus, the policy response. Specifically, the coronavirus lockdown damage is lingering, and local and state-based virus policy diktats, including volume and profit-killing social distancing and mask diktats, continue to weigh heavily on both demand and supply. Think of blocking off half an airliner's seats for the supply example. Think about bars or restaurants that you can only enter with a mask or sit 6 feet apart on the demand side. Those diktats are chilling as concerns the prospects for any kind of sustainable economic recovery beyond all the hurdles we face. I'm talking about beyond the debt, the misallocations, thanks to artificially cheap money, the yield starvation, lack of capital formation, the regulatory compliance cost insanity of about $1.9 trillion in the U.S., the, no surprise, plummeting productivity, and the heightened virus-based litigation concerns that are already weighing enormously on what's left of free market capitalism's ability to generate the greatest amount of wealth and happiness for the most people. To add unnecessary insult to injury, a so-called second wave of coronavirus cases has commenced. I'm sure you've read all about it. This was to be expected given how many students and workers were ordered to stay home and are now once again at somewhat greater liberty to venture into a wider world. Thank you, politicians and bureaucrats. But for how much longer will they be able to venture into that wider world? I'll get into that. And the renewed destructiveness of a rapidly spreading lockdown revisited policy response. If that wasn't enough, all the leftist politician-promoted rioting against systemic discrimination has also led to a lot of outdoor activity. All of a sudden, masks and social distancing don't seem to matter to the powers that be as much, at least on the left. And they were also condoned, if actually not promoted, close encounters that resulted, not always the very pleasant kind, but more the violent and destructive kind. I'm talking obviously about riots. So this has obviously heightened the amount of social contact. Well, all that said, most of the apparently only fleeting reduction in social distancing and lockdown diktats is nothing other than a return to more normal human interaction, which has belatedly brought lots of young people and working people to again rub elbows and more that for months they couldn't. Of course, this will increase virus cases, which would have already happened if only the elderly and vulnerable had been appropriately sheltered and life for the rest of us continued as normal, as it did before. That is, as happened during every other modern day pandemic response prior to this one. But more expanded social interaction, or just more social interaction, doesn't mean that virus deaths will skyrocket together with more cases. Nor does vastly expanded coronavirus testing, over 30 million in the U.S., and confirmations of a growing number of virus cases amongst a broader and younger population cohort than before, this doesn't suggest greater virus deaths or death rates either. Actually, to the contrary, because as an increasing pool of young or younger people get tested, a cohort with an extremely low mortality rate, the overall coronavirus mortality rate of those that have contracted the virus will continue to decline. This is good herd immunity news, right? Not bad news. And it is the proof, okay, of this. Well, the proof is in the pudding. Specifically, the once feared or fear-mongered over, if that is a word, coronavirus mortality rate, which was supposed to be in the 1% to 5%, the sky is falling range, isn't anywhere near that the further we get into this pandemic evolution. Instead, at least in the US, the mortality rate of those that contracted the virus keeps coming down, having declined to 0.26% of those exposed to the virus. The more people get tested, the more this actually comes down. This is a rate, the 0.26%, the mortality rate, that is closing in on the 0.1% flu mortality rate from a run-of-the-mill flu, not the feared or trumped up 1 to 2 or 3 or 4, even 5% mortality rates, or Armageddon, as was broadly disseminated by our mainstream media and others. The declining mortality rate is perhaps best displayed by the following chart, which comes from Our World in Data. Now, Our World in Data is a leftist-leaning outfit, and it aggregates government data coming from places such as the CDC, the Center for Disease Control in the United States. Let me see if I can pop this up here to show you more graphically what it is I'm talking about. There we go. Boy, I got lucky. What we see in this rather busy chart, and this pertains to the U.S., is the red line, that's this one, shows the cases, all right? And you see this rapid rise in early March, then a spike, and then a leveling off, and now this reacceleration in new cases, okay? But contrast that with this blue line. This isn't a logarithmic chart, so it doesn't show as well. But what you have is a pronounced and sustained decline in coronavirus daily deaths, juxtaposed upon a spike, thanks to some lockdowns ending, at least now, perhaps not permanently. So you see this is the divergence between this spike, all right, in new cases and at death rates. Concretely, as on June 30th, all right, on June 30th, there we go, I'm doing my best. I'm sorry, this is always less than perfect. But on June 30th, we had in the United States 41,556 new confirmed COVID-19 or coronavirus cases and 336 deaths. Now contrast that, and I got it here in blue, with daily deaths, the 336, which are down from a high of 4,928 daily deaths on April 16, 2020. That's this spike right here, all right? When daily confirmed cases totaled only 30,000, all right? Here. You can't see it too well because I've got this bar going across. But we're talking about daily deaths down, wow, from 4,928 in April to 336, even as daily confirmed cases has gone from 30,000 to over 41,000. And this is broadly reflective of a younger, healthier pool of people that are contracting the virus and able to put it down. But I'm getting ahead of myself. Let me also say that the coronavirus mortality rate in the United States would have been much lower, 20 to 25% lower, if doctors and hospitals hadn't been financially incentivized to over-report coronavirus deaths. Right? I've got various links here. In other words, if they labeled a death a corona death instead of one of the contributing diseases, whether it's heart or or based or cancer based or any of these terrible things, then they got more money through the CARES Act. Right? In addition, the real mortality rate, the one adjusted for reality, all right, would have been lower in the U.S. if in numerous Democratic-run states, such as New York, elderly coronavirus patients hadn't been forced into the very nursing homes that were supposed to shelter the aged and infirm from the virus. In that sense, consider that in the U.S., 43% of total coronavirus deaths have occurred in nursing homes. Do governors such as Cuomo in New York have blood on their hands or what? Back to the virus mortality or death rate for a moment. For this is the salient public policy point, whether it's a municipality, a county, a state government, or the federal government. That 0.26% and falling coronavirus mortality rate, right, that number is in line with or below other previous pandemics. It is also in line with leading immunologists' claims, repeated claims, made months ago and doubled down on, be they from Stanford, Yale, or Rockefeller College. Namely, that the risk to the average person living in the United States of succumbing to the coronavirus was akin to the risk of an average American dying in a car crash. Yet we still drive cars, don't we? Get the policy implication point? Open up the damn joint, despotic politicians and bureaucrats, and stop being economically and civil liberties destructive just so that mentally incapacitated Biden can win over Trump in November and civil liberties destructive policies get even more entrenched. All right? The same goes for the Senate. All right? But sadly, and politically, and most destructively, new virus-based lockdowns are ramping up all over the place, not only in the United States. This is largely thanks to what I'll openly call the Pravda Press's endless second wave of new coronavirus cases drumbeat, which drowns out both lower coronavirus mortality rates and perpetually lower daily death counts. Yet, America, and again, numerous other countries, are reinstituting civil liberties crushing and economy withering lockdowns. Of course, fascist Google is doing its bit. For flavor, just go on Google and type in any number and then add the words coronavirus or COVID-19 and you'll find an article on it. How convenient, how convincing. Try it yourself. Enter, for example, 999 new cases or 455 new cases or 247 new cases or whatever, and you'll see a new coronavirus or COVID-19 viruses case story. I discovered this by sheer coincidence a few days ago and forgot about it. That is, until a very recent and great SGT report video on this reminded me of it. Let me move briefly to other less than palatable topics. The unparalleled looting, vandalism, mayhem, injuries, and even deaths related to nationwide rioting by self-proclaimed Marxist groups such as BLM and Antifa. These are anarchistic and racist groups that ironically claim they are fighting against systemic racism. This is adding even more economic, social, and rule of law / property right protection concerns and upheaval, especially as politicians either encourage it on the left, the Democratic Party, or refuse to address it, including the majority of rhinos, Republicans in name only, which are the vast majority of the Republican Party. And this is true both at the state and federal level. Sad, but true. Well, speaking of true, the truth is that these anarchistic, well-organized, often well-funded groups' heart doesn't lie in eradicating systemic racism, because there is none in the United States. Else why in America would we have record numbers of interracial marriages, top political positions, right up to the President of the United States, frequently occupied by blacks or Hispanics, huge attendances despite sky-high ticket prices at sporting events, frequently dominated by the best athletes, in this case black athletes, or decades of unsurpassed immigration from south of the border by people that typically have brown skin. Would this be possible? Any of this be possible? Or would this happen if America was systemically racist? This is unadulterated BS. And you know it, and I know it, and they know it. If anything, it is the democratic domination, political domination, bureaucratic domination of cities over decades that has led to an expanded minority community injustices, from lacking school choice to promotion of state dependency over furthering an intact nuclear family. And the nation's sports superstars, who earn multi-millions, who often fled ghettos and live in very upscale communities with security guards. Those are the same individuals that claim solidarity with their old neighborhoods, yet want to deprive them of community police and property right protections that they enjoy in spades. What a double standard. Meanwhile, these superstars scold America for being racist and discriminatory, even as they cheer on communist China's repression, brutal repression of their citizens' rights. Why? Because these superstars and their leftist corporatist league owners stand to make billions off of Chinese contracts. That is, if they don't piss off the Communist Party leaders with civil rights concerns. What absolutely disgusting, race-baiting, selfish fakes. What criminal fraudsters. Sadly, Hollywood, the press, and fascist corporatists that want to take down Facebook for welcoming non-leftist opinions, including the likes of Delta CEO, are eager to peddle this societal destruction movement claptrap instead of promoting free speech, free market capitalism, school choice, and property right protections, which is what they all want but don't want minority communities to have, and that's their only ticket out of the trouble that they're in. This horrific demagoguery and the cheered on anarchistic mayhem, including defunding or incapacitating or shuttering police departments, will likely end up depopulating American cities and have urban Americans move to the suburbs or the rural areas, especially in red states where property right protections are still much more intact and police presence is appreciated. Let me save the most Recent legislating from the U.S. Supreme Court bench details for another time. Suffice it to say that America's highest court, recent legislating, and I say that purposefully, the legislating that America's highest court, the U.S. Supreme Court, has done from the bench is further disenfranchising representative government and separation of powers as it increasingly usurps legislative powers from the only body they were given to, Congress. In the process, running roughshod over more and more powers delegated to the legislative branch under Article 1 of the U.S. Constitution. In addition, that same court is further eviscerating federalism, and that is an evisceration of Articles 4 to 6 of the U.S. Constitution. Now, if that weren't enough, recent majority Supreme Court opinions are contorting the Constitution in terms of interpreting it in activist, contrived terms, not in originalist terms or as the Constitution was written and as per the intended meaning, which they are supposed to uphold. This judicial tyranny increasingly threatens the viability of an erstwhile federalist, constitutionalist, representative republic in terms of inalienable rights, individual freedom, and economic vitality. In closing, despite these increasingly damaging economic, financial, political, and societal developments, many U.S. stocks and most bonds around the world remain dramatically detached valuation-wise from the very trajectory which not only threatens return on owners' capital, share owners, creditors, bondholders' capital, but the return of that capital itself, at the very least in purchasing power terms, which may very well end up being a fraction of today's. This can be due to the ravages of inflation or to the advent of a powerful bond bear market triggered by surging yields thanks to bond vigilantes overpowering central banks' printing presses. It has happened many times before, and it will happen again, despite the happy consensus that it's impossible this time around. Well, when that happens, it may happen in an unparalleled manner. All right, the bond vigilantes throwing their hat in the ring, selling bonds, demanding higher yields. Why in an unparalleled way? Because we have unparalleled U.S. and global debt. Translation: government junk bonds can't be ZERP and NERP bonds forever. And I did say government junk bonds can't be NERP and ZERP bonds forever. They've got to yield a lot more to compensate for the huge risks, both solvency and inflation risks, that bondholders face while getting no yield. And this could happen perhaps sooner than people think possible, and will likely bring back double-digit yields once the elites lose controls. I know I sound like a record with a skip in it, but not only do I think we are broadly and sadly going vertical on the J-curve of free market capitalism and freedom destruction, but we are accelerating in our trajectory towards socialism at warp speed. And socialism always impoverishes and disenfranchises the masses while elevating the elite to untold power and wealth. The strategic allocation implications behind this, or as a result of this, are very clear. Sell the overvalued bonds and stocks that central banks are buying, and buy what they have long manipulated down and have long talked down. I'm referring to fiat monetary regime kryptonite, namely physical gold and silver. Or, for the more adventurous, consider purchasing a good portfolio of precious metal stocks, such as one managed by Peter Schiff's Euro-Pacific Asset Management. If substantial mining risks can successfully be overcome or at least neutralized in a basket approach, the incredible bottom line leverage of a mining business in a time when demand is robust and its average selling prices are rising much more rapidly than its cost structure is increasing, it's currently actually falling, well, this will make gold and silver appear relatively weak in comparison to what is going to happen to mining stocks. In other words, the mining stocks will be gold and silver on steroids, kind of a speculation that could result in 20, 30, or 40-fold gains in fiat currency terms because investors still haven't priced in sharply rising precious metals prices. Said differently, if you think silver or gold could be a 10 or 20 bagger, then you can add or double or triple that with successful clutch of mining stocks purchased at today's prices at a time when investors still don't think that gold prices are going to go up, much less prove sustainable at current levels. By the way, let me just state that I have zero financial incentive to recommend Peter Schiff's precious metal fund. Well, that's all for today. It is July 1st, 2020. Over and out from bucolic Niederweningen, Switzerland, where summer has returned in all its splendor and warmth. Thank you for listening. Bye-bye.